Good morning, everybody, and welcome to our August IFRS webinar. Before we go much further, I would like to use the opportunity to congratulate my fellow partner, Kevin Frobus. He's been doing these webinars with me since the beginning of the year. He joined BDO about 18 months ago as an associate director, and we are very excited to announce that he's been promoted to a partner on the 1st of July 2019. So it's fantastic to have him as a partner. Kevin is still based in Sydney, and therefore for all our attendees of the webinar, our clients, potential clients based in and around Sydney, please feel free to reach out to Kevin. So congratulations, Kevin.
Thank you, Aletta, and good morning, everybody.
Then for today's webinar, we're continuing our short series on disclosure. It's that time of year where we are finalizing our June 2019 financial statements, and it's all about how do we disclose these new standards in the financial statements. 2 months ago, we had a webinar around the disclosures of IFRS 16. Last month, the Dean, who also joined us recently as an Associate Director in Melbourne, talked about the disclosure requirements under the new IFRS 15. And then this month, we'll be looking at the disclosure requirements under the new IFRS 9. And next month, we look at the disclosures under the new AASB 1058 for our not-for-profit clients. We just want to note that in this particular webinar, we're going to focus on the more common changes to the financial instrument disclosures, and specifically those arising from transitioning to IFRS 9. Now you'll see there's extensive disclosure requirements, but we're focusing on the more common changes that's occurred. So just to create the expectation up front. If you look at financial instrument disclosures, IFRS 9 is the new financial instrument standards, and it's talking about recognition and measurement. But the disclosure requirements are in IFRS 7. And when the new IFRS 9 was issued, there was also at the same time changes to IFRS 7 to update the disclosure requirements around financial instruments. So it's important that you don't look for the disclosure requirements in IFRS 9, but actually go to that separate standard, IFRS 7, for the disclosure requirements. And we know the other standard dealing with financial instruments would be AASB 132, which looking at presentation. Before we look at the details, we would like to highlight the disclosure objective. And that is the IFRS 7 has two key disclosure objectives. The one is around or the overall objective is we provide financial instrument disclosures so users can evaluate two things. And in the block on the left-hand side, so users can evaluate the significance of financial instruments for the entity's financial position and performance. So it's so people can see how many financial instruments we have, what are the size, how important it is to our business. So that is the one disclosure objective. The other disclosure objective is the block on the right-hand side. And this one is often overlooked. And this one talks about the nature and the extent of risks arising from financial instruments to which this entity is exposed during the period and at the end of the period, and very importantly, that last part, and how the entity manages those risks. So if an entity has financial instruments bring risk, often significant risks, during the period and at the end of the year. And there's a requirement, or there's an overall objective, an overall principle, one could say, in IFRS 7, that an entity should disclose not only what those risks are, but how the entity manages those risks on an ongoing basis. So I think it's important to get that overall perspective before we look at it a bit more closely. Before we go further, we would like to highlight that at BDO, we've been doing these webinars now for close on 3 years. And very recently, we've also launched our e-learning, and all of this free of charge to anybody. Now, in our monthly financial reporting webinars, and they are all available, the recordings, the PowerPoint slides, etc. Over the last 2 years, we've looked at hedging, we've looked at impairment, we've looked at classification and measurement, problem areas, risk assessment, transition, a number of aspects covered during 2017 and 2018. Those aspects were all around really recognition around measurement. And now in 2019, we are looking at practical issues when we implement IFRS 9. We did that in March. Because a lot of our clients have started implementing 9, we became aware of some practical considerations and we've highlighted those. And this month, we're looking at disclosing the impact of transitioning to IFRS 9, because we know for entities with a 30 June year end, 30 June 2019 would be the first time they've adopted, implemented IFRS 9, and now they have to also comply with these additional or changed disclosure requirements. So there's a lot of webinars available that can assist you around IFRS 9. We've also launched e-learning, and in particular, there's an e-learning course, and the link we've provided for you, where you can look at IFRS 7 changes in the disclosure of financial instruments for corporates. In this webinar, we basically look at a lot of examples from those materials. So if you want to look at it in a slightly different format, you could do that. But today we're really talking you through those changes as part of the webinar. Before we look at the disclosures, I think it's important that we do a little bit of an overview of the more common concepts of IFRS 9, because this gives us an understanding of what to expect and how it links to the new disclosure requirements. Now, first of all, we know that previously under AASB 139 or IAS 39, we had 4 categories of financial assets. We had fair value through profit and loss. We had loans and receivables. We had held to maturity, and we had available for sale. And we know that available for sale was usually the catch-all or the residual category. Under the new, and that's on the left-hand side, those 4 categories. On the right-hand side, we still have 4 categories of financial assets, but they now describe slightly differently. We've got fair value through profit and loss, which is the catch-all residual category. We've got amortized cost. We've got fair value through OCI for debt instruments and fair value through OCI for equity instruments. And it's very important that we distinguish between the debt and the equity instruments when we have fair value through OCI, because with debt instruments, we can have recycling, and with fair value through OCI for equity instruments, there's no recycling allowed. So if we look at this slide, the purpose of this slide is really to say, yes, we've got 4 new categories of financial assets, but you can see that there could be quite a bit of movement between the categorization under IAS 39 and how we've put it into categories under the new IFRS 9. If you look at available for sale, the yellow one, it could go to anything under the new IFRS 9. Held to maturity could go to amortized cost or fair value through OCI for debt. Loans and receivables the same. So there could be a lot of classification changes, and how do we deal with the disclosures when that happens? So the key thing around classification, or the key changes around classification, has been around financial assets. A different way to look at that classification, or how to determine what the appropriate classification could be, there's 2 angles. First of all, we'll look at the cash flow type. And we talk about the SPPI test, solely payments of principal and interest. And if you meet the SPPI test, you then consider the business model, and there could be one of three business models. If you meet SPPI and it's hold to collect, then you've passed both hurdles to get to amortized cost. If you pass SPPI, but your business model is to hold, to collect, and sell, then you've got fair value through OCI, which is for an equity instrument. And if it's neither of those, then you get to fair value through profit and loss. And remember, we said fair value through profit and loss is like the residual catch-all category. If you don't pass the SPPI test, you go straight to fair value through profit and loss. So very important when we think about classification, and in particular classification around debt instruments, important to consider your cash flow type and your business model and how they interact. The other thing that's a big change from the previous AASB 139 is impairment. And the new rules around impairment in IFRS 9 first of all says that we've got a general approach and we've got a simplified approach. And we'll get to the simplified approach in the next slide. But first of all, the general approach for impairment, and impairment therefore of financial assets, is that your financial assets have to be put in place whether the financial asset is in stage 1, stage 2, or stage 3. And we said stage 1 would be that this financial asset is actually performing. And when we enter into a new arrangement, those financial assets, loan receivables, usually would automatically start, in most instances, in stage 1. They're performing. We look at the 12-month expected credit loss, and we recognize revenue on a gross carrying amount. However, if there is a change in the performance of that particular loan receivable, our financial asset, and that loan receivable becomes underperforming, so there's a change in the credit risk, or there's a change in the risk of default since initial recognition, it would move to stage 2. The backstop is if it's more than 30 days past due, it would go to stage 2. It's now underperforming. We now recognize lifetime expected credit losses. You still recognize revenue recognition on a gross carrying amount. And then if this particular loan receivable moves to non-performing, so usually the backstop measure is more than 90 days past due. We still use lifetime expected credit losses, but now we also change our recognition of our revenue. And now your interest revenue is actually based on the net amount, not the gross amount. So this is quite a big change to what we've previously had. You'll know previously there was criticism of AASB 139 that we recognized provisions for impairment or bad debts, a little bit too little, too late. Usually we only recognized it once we hit what is now known as stage 3. And also continue to recognize interest revenue on a gross amount. So there's two big changes here. The one is the staging around expected credit losses, and the other thing is the impact that it has on the revenue recognition. I also said that for impairment, there's a general approach and there's also a simplified approach. So the simplified approach would apply to trade receivables and contract assets, contract assets under IFRS 15, if they don't have significant financing components, and that would be mandatory. If you have trade receivables and contract assets with significant financing components, you've got a policy choice to do the general approach or the simplified approach. And if you've got lease receivables, you've got a policy choice. So I think it's important when we look at impairment to first of all look at, do I apply the general approach to my particular financial asset or the simplified approach, and what are the rules around that? If you use the simplified approach, it's where we would use a provision matrix, where we cut and dice our loan receivable to say, put it in categories as in current, 1 to 30 days past due, 31 to 60 days past due, 61 to 90 days past due, and potentially more than 90 days. And I just want to say this example is just an example. There might be a better way to cut and dice your loan receivables, but this is what we've decided to illustrate here. It's out of our IFRS in practice. And then for each of those buckets, you would put an expected default rate. Now, again, these expected default rates are just default rates that we've created for the purpose of the example. In no way are we saying that expected default rate for all receivables using the simplified approach for 1 to 30 days is 1.8%. So those are made up numbers. If you apply those expected default rates to the gross carrying amount, it would give you your credit loss, and you add that up, and that is your provision that you would create. So I will now hand over to Kevin, and Kevin will discuss and presenting and disclosing transitioning to IFRS 9, also other important disclosure requirements lining up with our overall disclosure objective, and then I'll speak to you again at the end around some video resources that's available. So, Kevin, I'll hand over to you.
Thank you very much, Aletta, and thank you for that overview. I think the overview leads quite nicely into the section I'm going to present, and I think it's important to note that we're demonstrating here also the common transition disclosures. So these are almost your bare basics, if you want, the things that most corporate entities run into on transition. So it's important to note that obviously there's a lot more that goes with this, but today's webinar is really just down to the basics. So heading into the content then, I've put together a number of slides, and the first one is really the basic requirement of explaining transition. Now the next 4 slides are very dense in terms of wording. There's a lot of words going on here. These are extracts from the accounting standard, and I think it can become very quickly overbearing when you start to read the requirements of what's required by the standards. So what I'm going to do is I'm going to whip through these next few slides and really just point out some of the key basic requirements. I think the first one, which is on the screen now, is actually not in IFRS 7. It comes out of the accounting policies standard. It's a basic standard in terms of choosing accounting policies and disclosing accounting policies. And it's really an old concept, the concept of explaining a change in accounting policy. And in this case, the change in policy is because of a new accounting standard. In this case, IFRS 9 is the new accounting standard. And the requirements really is to say, well, look, we've adopted a new accounting standard. What date did we adopt it on? What's the title of the new standard, which will be IFRS 9? And then to describe the nature of the change. And then if you look down to number F, the changes for the current period and prior periods in terms of actually a number and reconciling that to the amounts presented. So that's a very high level of the requirement. That shouldn't be a surprise to anybody. That's an old concept, which is really just taking the user on a journey that there's a new accounting policy and how you got there. The idea then is that you're going to have adjustments to your financial statements. Now, normally when you do a new accounting standard, you've got a retrospective adoption, which means you've got comparatives have been adjusted, and you would normally have a third balance sheet being right back to the beginning of the first year presented, and then you would take the user on a journey on how you've made the adjustments and what has changed in your financials. With IFRS 9, there is a choice. And that choice is essentially to apply the standard retrospectively, but not to adjust your comparative. So it's one of the transition choices allowed in terms of the adoption or transition to IFRS 9. And it is the most common one we are seeing, not exclusively. There are a number of entities that do full retrospective, but most of the corporates and the smaller entities and the less complex corporates are adjusting or reflecting the transition in this modified approach, which is really you make the adjustment to the opening retained earnings in the current period, and you don't adjust the comparatives in the balance sheet and comprehensive income, profit and loss statements, and so forth. Now that represents somewhat of a change to what we're used to. We have seen it in IFRS 15 as well, so it's not that new, but it is something that a lot of entities are grappling with, this concept of comparability, which doesn't reflect in the financials. And a number of entities take that route because it actually saves them the hassle of actually going to adopt the comparatives. But that does actually then leave you with the requirement to explain the fact that your comparatives aren't comparable, which means in your disclosures you need to actually explain that and show how the user how the numbers in the current year aren't comparable to the prior year, but then what's happened to the current year, and essentially give enough information so the user can actually do that comparative themselves if they want to. So moving on then to IFRS 7, and this is where it gets really complex. The big thing with the next slide is that it starts to actually talk about lots of words, lots of measurement categories, all these big words popping out, but the key words that are going to come up as a basic requirement is the measurement category. And that was what Aletta was talking about before, about the 4 categories in the past, which were held to maturity, available for sale, fair value, and so forth. And they've moved to the new 4 categories, which essentially are fair value through profit and loss, fair value through other comprehensive income for debt and some equity instruments, and then your amortized cost category. And on the face, it looks a lot like the measurement categories haven't changed, and this is especially true for trade receivables. Trade receivables is a good example of an instrument that moves from one category, loans and receivables, to a new category, which is amortized cost. And on the face, it looks like not much has changed because both were really an amortized cost method. But what's important here to note is that that under IFRS 9, some of the measurements under amortized costs have even changed. And that's particularly true for modifications and derecognitions, where the way we do or the way we calculate amortized cost, there's been clarifications, there's been amendments. And so you can actually have an adjustment to the opening retained earnings under the amortized cost method, depending on how you applied amortized cost under the old standard and depending on whether that's consistent with the new standard. So understanding, first of all, which measurement category it's gone from and which measurement category it has gone into, it's really important as a first step, but then also explaining whether there's actually been an adjustment because of that change. So the key learning here is to have a look at all the stuff. There's paragraph 42I on the standard, but it's actually the starting point of your category disclosure on transition, which is really which category did I start in, which category have I ended up with, and then also what's the carrying amount under the 2 and whether there's been an adjustment. That's the key learning from this slide. If I move on to the next slide, lots of words again, but really the next slide is actually trying to articulate that when there's been this move from one category to another, there will normally be adjustments that come with it, but then also qualitative information that can help the users how you got there. And really what we're talking about here is sort of the judgments you've made and how you've made a decision to move something from one category to the next. In Aletta's slide, when she spoke about the category changes, there were lots of arrows all over the place, and Aletta used the example of available for sale, which can essentially end up in any of the new 4 categories. How it ends up there is sometimes a judgment call, but also sometimes it's because of the characteristic of the underlying instrument. And so what this is really on about is how did you get your category adjustments from one to the other if it's important to the user? So that's the narrative around how your categories changed. And then finally, if we move on to the next slide, This one will then talk about the changes to the carrying amount because of the measurement category change. So these last 3 slides that I've spoken about, there's a lot going on there, but really the concept is take the user on a journey. Where did you start? Which category were your financial instruments in? Which ones did they go to and why? There's the qualitative or narrative that you provide, and then reconciling the adjustments, if any, and also then relating that to your balance sheet and whether you've actually adjusted the comparatives. So what I'm going to do now is then move on to some examples. I actually think there might be another slide that I've forgotten about, and that's actually the reconciliation of the impairment allowance. I've actually snuck this one in because it is a basic requirement. Every entity actually has, to a large degree, trade receivables, and as Aletta explained with the general and the simplified approach, most entities actually will have an adjustment to their allowance or their provision for doubtful receivables, and that is because, yeah, especially in the simplified, you can see we've got a default rate applied even against current receivables. Generally, before, we would only record the allowance when there's objective evidence of an impairment, but now you'll actually see that there'll be earlier recognition of these lifetime expected credit losses. So most entities will actually have an adjustment to their allowance, and because the standard is a retrospective standard, even if you're not adjusting comparatives, there is an adjustment to be made to prior year receivables because of this new policy. So you will generally always, if material, have an adjustment because of your allowance change against the open retained earnings in the current year. So this particular disclosure, 42P, is actually saying, well, please reconcile last year's allowance or provision with this year's allowance, and then show how it moves through the current year. And I've actually got an example of what we're talking about there. So let's move on to those examples then. But bearing in mind, again, this is basic requirements. So I haven't disclosed everything that's required. It's just the important disclosures that one might make to get through the common types of receivables. So this is a description taken off a half-year set of financials, which will then feed into the annual financials of an example entity. And I'll take you through the various paragraphs and what they were trying to do here. So first of all, at the top, it's AASB 9, which is the Australian equivalent of IFRS 9. And yeah, they're actually saying, look, we've adopted this new standard on the 1st of July. So that's your normal disclosures, adopting from the old to the new, the date of adoption, the title of the standard. So this is your IAS 8 disclosures for any sort of change in accounting policy. And really what it's just saying is, in that first paragraph, it's giving a bit of background to the fact that there's been a change. It then actually breaks it down and says, well, let's talk about classification. And so it actually says here that from the 1st of July, under the classification heading, there are now, for financial assets, various categories, and here it's the fair value through other comprehensive income, fair value through P&L, and the amortized cost category. At this point, they haven't broken the fair value to other comprehensive income into debt and equity. So there's 3 categories there, but of course the other comprehensive income category actually has a debt and an equity, and that will reconcile to Aletta's 4 categories in the diagram she had in her overview. And then they start to talk about the trade receivables and the business model that's used to actually categorize trade receivables into cash flows, about solely principal and interest, and how that then relates to what they've done in the current year. And this is the journey, the narrative that takes the user on the journey about, we've had this change, there are these categories that change. The category or the classification is dependent on these business models and a couple of other tests. And then the important one, in that 4th paragraph, which talks about the trade and receivables, they actually say in the last sentences that the balances are measured at amortized cost under AASB 9. This is for trade and other receivables, which is consistent with their treatment in prior years. Now that's really important, because what you're saying here is the category has changed. We've got this new classification model, but the measurement is still amortized cost. Now that's not always how everybody does it. Most organizations are actually putting a table in, and they'll actually have a table which has the balance sheet items listed in the first column, the old category in the next column, and then the new category in the 3rd column. And that's perfectly okay. It's a lot clearer. You can put a table together and you actually show that type of disclosure. In this case, they didn't, but it's important to actually relate your balance in the balance sheet through to what it used to be through to what it is now. And then it moves on to the next line, which is actually about this irrevocable election on available for sale. So very importantly, it's actually saying we had these available for sale investments, and we've now made this irrevocable election to measure them at fair value through other comprehensive income. And then there's a sentence and talk about there's no adjustment arising from that classification on the date of transition. Now that's really important as well, because what they're saying is, even though there was no measurement adjustment to be made in the open and retained earnings on transition, it's telling you that there's been a category or classification change, and it's telling you what that change is, and it's also telling you the judgment about how they got there. The way they got there was they made the election to put it there. So it's not that the policy was forced on them. There's a choice to be made on those types of investments. They've made the choice. Management have elected an irrevocable election to put it into that category. They've told you that that's how they got there, and they've told you how they've ended up there. And then a very nice sentence is, all the other financial instruments, in this case, there was no change in classification. Bit of a nuanced sentence, because there really is a change in classification. I think what was probably meant there was that there's no measurement change of the classification. As they say there, they all continue to be measured at amortized cost. Perhaps maybe that can be tightened up to actually be a little bit more clear, but I think for the user in this case, it's probably clear what's going on there. And off we go. So the next slide we move along to then is a continuation of these disclosures, and here we actually have a paragraph on impairment. Now this one here, they talk about the trade receivables, because that's where the adjustment has, and very clearly they actually say they've used the simplified approach. In the second paragraph, they use the simplified approach, which means they've mandatorily applied that to their trade receivables. They're using historical default percentages for the portfolios. They've put forward-looking information in, which means there's going to be an adjustment, and then they've actually shown that adjustment. So here's the adjustments through to the open and retained earnings at the beginning of the year, and then how that happened on transition. So there was an adjustment there. Also, very importantly, they made the statement that the comparatives haven't been adjusted. So it says very clearly in the center of the slide, the group has not adjusted the comparatives, but the effect of that has been on the 1st of July, which was the date of transition, they've actually changed their retained earnings. So that's a nice little reconciliation. And then the final slide, well, the penultimate slide in this example, is then how the line items in the balance sheet have changed. Now this is important because they actually haven't adjusted the comparatives. The comparatives have not been adjusted, but what they've done is they've actually shown which line items in the balance sheet have changed at the transition date because of taking this transition adjustment through open retained earnings. In this case, it was the finance lease receivables and the trade and other receivables. I see a lot of entities that actually repeat the entire balance sheet in the note, and that's appropriate as well. Sometimes when you adopt IFRS 15 and IFRS 9 together, there's a lot of line items that change, and those requirements are made. But in this case, they just had 2 line items in the balance sheet which were affected by that open retained earnings adjustment, and they've shown that essentially as an extract. And then finally, as I mentioned, is they've actually shown how the provision for doubtful receivables reconciled at the bottom of that previous slide. This last slide that Alette's brought up for us is the statement of changes in equity. Probably a little bit busy for the webinar, but you'll see that in the second line of the statement of changes in equity, a 1-line adjustment showing the effect of the transition to AASB 9. So essentially, it's a change in policy, which means your equity reconciliation must show that adjustment. What was the balance in equity last year at the closing balance, 30 June 2018, an adjustment to the restated balance at 1 July, and then off you go with the rest of your comprehensive income adjustments for the year. So it's essentially the same as any prior adjustment. But what's interesting to note here is, and I don't have that on the slide, but your prior year statement of changes in equity would not have a AASB 9 adjustment, because remember, we didn't adjust comparative. So there'll only be adjustment to the equity in the current year statement of changes in equity. That's a very high level demonstration of the sorts of disclosures you would expect. I did sneak another example in, which is example 2 on the next slide. And this is one taken from the video e-learning module. The year of adoption year is different. The year of adoption year was 2017. So it was a different example. But what they did here was they actually listed the financial instruments by category down the side. So cash, trade, derivatives, and so forth. This is just the financial asset extract. And then what they've done is they've actually created a table where they put the new measurement category and then in brackets what the old measurement category was. So you can see the three columns are essentially fair value through profit and loss, amortized cost, and fair value through other comprehensive income. And in brackets for the last two, those were the comparative categories under the old standard, loans and receivables and available for sale. Bearing in mind, it won't always be that way. It just happened to be that in this case, the available for sales all became the fair value to other comprehensive income, and the loans and receivable all became amortized cost. But as Alex's example about available for sale could end up in any of the four categories, and then you would actually have to have columns for that. Because the important thing here is you're trying to tell the user which measurement category did it go to, why. In other words, was it a policy choice or the standard required it? And then how does the measurement policy actually change? Now, I'll use fair value through other comprehensive income as an example. The available for sale category in the past was a measurement through other comprehensive income. But the fair value through other comprehensive income is slightly different. The fair value through other comprehensive income actually has no recycling back through to profit and loss at the end. So even though it looks like the measurement and the classification looks the same, they actually are very different. Fair value through other comprehensive income under the new standard doesn't have any recycling back to P&L when those instruments are disposed, whereas available for sale did. And that's really important. And a number of entities have cottoned on to this idea, and they're actually making that statement. If you've got shares in an entity or listed entity, and you've chosen to move them to the fair value through other comprehensive income category under the new standard, it's important to note that they will never reconcile. They will never recycle back to P&L under the new IFRS 9, whereas with available for sale, they used to. What's important there is some entities have made the election, they've moved these things through to equity because they don't want to change the way they do things, but they haven't realized that the measurement classification actually does have an impact, and that impact will be on disposal. They'll never see the profit on those shares into P&L ever again, whereas under the available for sale, they would have. And that's a good example of an explanation you should be giving to your users, saying, we've made this decision, we've moved these instruments through, but this is actually going to be the impact of that change. The impact is you'll never see those profit and losses in the P&L ever again, whereas under the old standard you would have. And that's why it's so important to take the users on the journey about what's going to happen. I think I'll leave it there for now. We can talk about that all day, but I think I've pointed out the key areas. I did put a section in here which is equity instruments at fair value through other comprehensive income, and it essentially is an extract of the disclosures related to the types of instruments, such as investments, that have been irrevocably moved to this new fair value through other comprehensive income category. I've already shown you or demonstrated those in example. This is really just the disclosure requirements. What's important here is to actually be very clear which instruments have actually been designated as such, because some of them may still be left in fair value through profit and loss, others have moved through to fair value through other comprehensive income. The reasons for these alternatives and why you've done that, the fair values of which instruments are actually moved to the other comprehensive income category, dividends that came from those during the year, and so forth. And what they're really on about here is tell the users which ones of your investments as financial assets are now going through other comprehensive income and will never ever go to P&L ever again, and which ones are left behind in profit and loss as a policy choice, and explain the differences, because clearly it's a journey for your users to understand what's going to happen because of this classification change. So that's just there for information purposes, and I think I've actually got another slide which talks about what you do when you dispose or de-recognize those instruments. Why did you dispose them? What was the fair value, and what was the cumulative gain? And the reason why this is important is the gain or loss on those instruments that are now designated into fair value through other comprehensive income, this is equity instruments, they will never ever go to P&L ever again. So the disclosure is, well, we've made this loss. Where did we take the loss? The loss is in other comprehensive income, or the gain. It's never going to go to P&L again. And what you're trying to do is tell the users, if you want to understand that, here's the information so you can make the adjustments yourself. All right, I think I'll move on now to the exciting one, which is credit risk. This follows from the slide a letter put up originally, which was the disclosure objective. And the disclosure objective on credit risk is really just one of the risks that flow from financial instruments. Now, this is on the right-hand side, the nature and extent of risks, and very importantly, how the entity manages those risks. Credit risk is one that generally every entity has that grants credit, so trade receivables and really, your debt instruments. But bearing in mind, there are liquidity risks, maturity risks, market risks, price risks. Those are all types of risks that would have these disclosures if material or if significant, and you would have to disclose how the entity manages those risks. And there are specific disclosures that go with each of those, specifically maturity and liquidity risks. They're very particular qualitative and quantitative disclosures that go with that. I'm only going to deal with credit risk today in the interest of time, but also that's the common risk that everybody generally has. And the disclosure requirement here is an objective itself. You can see that this particular paragraph, the extract has got a red bar along the top, whereas the other extracts I was showing you, those were green bar disclosures. What this means is this is an objective itself, and below this, there would actually be specific disclosures that go with this. And so I've only just shown the disclosure requirement on the objective that you're trying to achieve with your disclosures regarding credit risk. And importantly, the first one is A, how has the entity managed that risk through its credit risk management practices? That's not a new disclosure, that's an old disclosure. That's things like we perform credit checks before we grant the credit and so forth. You're telling the user how does the entity manage that risk at the start. Those have always been required under IFRS 7. But where the changes come is you're really trying to reconcile that now with the expected credit loss model that actually recognizes a loss provision, and that's where, for example, quantitative and qualitative information in part B is required. Essentially, how do you reconcile your credit risk management practices to your expected credit losses, and then in C, where's your exposures and where are your significant credit risk concentrations? So I think the important bit of this objective is that you're trying to actually complete the picture for the users. What do you do to manage the risk? How do you evaluate it on an ongoing basis? And how does that reconcile to your loss allowance or your provision for doubtful debts that you've recorded? It's a difficult thing to achieve. A lot of entities will probably take a number of years to actually refine this. I think the danger here is that you use boilerplate type disclosure, which actually it doesn't relate to your entity, and you very quickly fall into this trap where it doesn't actually provide any information to the user. It's just copy and paste. Whereas actually what they're trying to get here is actually specific information that is unique or relevant to your particular entity, as opposed to kind of talking about information that actually is just high level boilerplate language which everybody puts in but doesn't actually mean anything. So I've put a few examples in here of how this might work. Also, once again, these are just examples on this. This is example 3 is really just a narrative of the credit risk management practices. To be frank, there's probably a couple of sentences in here that are boilerplate, but you can pick out a couple of key sentences that are unique to this entity. In the second paragraph, they actually talk about the fact that they've got a risk management committee, so that's unique. They've established a credit policy, which is great, and they actually analyze individually credit worthiness before payment and delivery terms are set. So yeah, they're talking about their credit risk management policies. They talk about bank references being obtained. They talk about purchase limits being established. So that's quite unique. That's quite specific. It's actually specific to this entity. And then they talk about concentrations of credit risk. They actually monitor those for credit worthiness through monthly reviews, and they actually grade them as high risk and put them on a restricted customer list. So it's a good example of a narrative that talks about the credit risk management processes. This is obviously before credit is granted. So what happens after that? Well, the last paragraph will then say, well, once credit's granted, we then evaluate that, are the guys going to pay, and so forth. Aletta then brought up the next one, which is the provision matrix, which is good. So yeah, what they've done is we're now talking about, we've got at the closing balance, we've got our carrying amount for receivables, and then there's an expected default rate that's been measured against those using our provision matrix. Now, in this particular case, I haven't actually given you a disclosure of how the default rates have been calculated, but the disclosure it would be expected that you'd actually disclose those default rates. So this block that I've brought up here isn't only an example from our IFRS in practice, which can be found on the video website, but it's becoming common practice, or it's required common practice to actually put those default rates in for those categories. So get ready for the concept that that's expected disclosure. You need to disclose really how you've measured your expected default rates, and the way they've done it is you stick the disclosure in, you show the measurement categories, you show the gross carrying amount, and you show how you get to your credit loss allowance. So that is great disclosure right there. The bit at the bottom is a bit of disclosure talking about then concentrations, and yeah, they actually talk about at the end of December 2018, which is the year in this case, there were a couple of receivables that actually had the full value that was essentially provided for, and they talk about that being related to 2 customers in the southern region. So there's a southern region of where they do their trade. That's where the concentration is. There's clearly a problem there, and that the reason why they are a problem is the production facilities of those receivables were destroyed in fire. In the previous year, it was 3 customers in the north. When I read that, I actually think that there's probably somebody setting fire to the production facilities of our customers, and they were in the north last year, and they're now in the south. I'm not really sure what they're trying to say there. It seems quite suspicious if you talk about it to me, but they're making the disclosure about where their concentration is. Where are they struggling through? Very often, what you're actually trying to do is give the disclosure about the fact that you might be trading with certain customers in a particular region, and the risk has changed in that region because maybe a factory closed down, or that particular region is going through, an area of negative growth, and therefore you're worried about the recoverability in those regions. And that's the sort of information they talk about in terms of disclosing your concentrations of credit risk. I actually reviewed a set of financials the other day where they made the disclosure that there were no significant concentrations of credit risk, but in another part of the financials, they spoke about the fact that, I think it was in their segment report, they spoke about the fact that 50% of their sales was made to 4 customers. Well, clearly the concentration of credit risk was in those 4 customers. So that was an example of a boilerplate disclosure in the one side of the financial, but then an actual disclosure that was specific to the entity in another, and they were contradictory. So just want to watch out for that type of thing. All right, I think that's it for example 4. Finally, I actually put this one as a bit of a catch-all. The simplified approach generally applies to trade receivables, but for your related party loans, it's important to note that the simplified approach doesn't get applied to loans to related party. You actually have to apply the general approach, so stages 1, 2, and 3. And what's important to note is that if you have loans to related parties, they are subject to the new model as well. This is a big shock for a lot of entities. For a lot of consolidated entities, these balances cancel out, but that doesn't mean the concentration of credit risk goes away or the credit risk disappears. There is still credit risk in the group, sometimes intercompany. But in this case, there's been no consolidation. There's a loan to related parties, so it's a financial asset, and therefore the general model of impairment must be applied, and in this case they've actually got an adjustment for that, a loss allowance. So it does look suspicious when you look at a set of financials under the new standard, when they've got loans to related parties but there's no expected credit loss against it. It means they haven't thought about it, or they haven't assessed it, and the disclosures apply equally under IFRS 7. Because you're applying the general model, there's actually some more disclosures that need to be given. The general model actually requires a credit risk assessment between when you initially recognized the instrument and at the reporting period. And that's important because the credit risk significant establishes essentially whether it moves from stage 1 to stage 2 to stage 3. And then also what's important here is you actually need to define the default. When would a default have happened? Under the simplified model, the definition of default is somewhat wrapped up in the default rate that applies to each of the age brackets. Whereas under the general model, you need to put a peg in the ground and say, well, when does default happen? What is default? How do we define default? Because then you're actually measuring the allowance in relation to that risk of default. It feeds into the 12-month lifetime expected credit or the lifetime expected credit, depending on which stage you're in. So in this case, they've actually described that. They spoke about the fact that the related party loan is repayable on demand. It's quite important. They talk about what the risk of default is, and they've defined what default means. First of all, these are repayment on demand, and so they talk about default being when there's evidence that the borrower is in significant financial difficulty, such that it has insufficient liquid assets to repay the loan. What they're really saying here is, at the reporting date on a repayable on demand loan, if the entity doesn't actually have liquid assets to pay, it's essentially defaulted. That's what they are saying. They do this on an individual basis, which is also very important, because generally under your trade receivables, you're doing a portfolio assessment of loss. But on loans to related party, they're telling the user that they actually look at them individually. So it's really important. And then they actually talk about credit impaired when it actually meets the definition of a defaulted loan. So they once again reconcile that back to the fact, does the entity have sufficient liquid assets to repay at the reporting date? And that's the important judgment there. They could probably go into a bit more detail on this one. Maybe it wasn't considered material, but I think the important thing is they've recognized the loss allowance, they've defined what default means, they've related the default to the repayable on demand status, and then they've linked that to whether there's sufficient liquid assets to repay in order to work out the expected credit. You can see it's not necessarily important to say it's a stage 1, 2, or 3. You don't have to necessarily say that. What they're actually trying to say is, well, how have we gone through this process? I'll hand over now to Aletta. I think I've rambled on enough, Aletta, taken us all the way to 10 to 12. So I'll hand back to Aletta to take us through to the end of the webinar. Thanks very much.
Kevin, thank you very much for that. I thought that was amazing. The way you've explained the principles, and I loved the examples, because often in these types of webinars, people just go through the actual requirements, but to see how it can actually turn into a real disclosure was really useful. So for me personally, I found that very useful, and I hope our clients and our attendees also found it useful. I want to thank you for the effort you've put into that, Kevin. It really is amazing and really, really informative. So thank you very much and well done. If we just wrap up the session on some additional video resources, first of all, I want to remind you that we've got e-learning, which is available on our website. It is free of charge. There are different categories or different sections in the e-learning, categories of financial instruments, looking at financial assets, liabilities, looking at reclassification disclosures, looking at impairment losses, etc., hedging, a lot of amazing information. We've got a great team globally, and some of them actually part of our Australian team who put this together. We're very proud of it. They put in some quiz questions, some examples, nice color, and we would really recommend that you have a look at that. It would really help you to make sure that you're across all the principles and also the disclosures. From a publication side, we have an IFRS in practice, which has been updated earlier this year on IFRS 9 in general. There's also an IFRS 9, IFRS in practice for related company loans, which really is an amazing publication, amazing document. And then we've also included the last one, model IFRS statements. So it's not the IFRS 9 for related company loans again. Sorry, my typo. It's actually model IFRS financial statements if you want to see some more examples similar to what Kevin covered today. These publications, again, available on our website. There's a lot of publications that are very useful. If you need any assistance, if you want to speak to any of us, our BDO IFRS advisory team obviously do written advice, guidance, etc. We do provide training. Particular for clients, we do risk assessment, we do consulting or customization of processes, we can help you develop policies, and we can do first-time adoption assessments. So if you need any of those in relation to IFRS 9, please feel free to contact us. I would have to add, remember we do this across all accounting standards, but the focus in recent years has been on the triple threat, IFRS 9, 15, 16, and also AASB 1058 for our not-for-profit clients. And in the world of leases, IFRS 16, we are super excited that we've got 2 service offerings. So we've got a software as a service BDO lead, a cloud solution, for entities with hundreds or thousands of leases, but we also do outsourcing of your leases, where we manage your leases on your behalf and provide the journals to you every month. So we've got specific tools that's been developed to assist with implementation of IFRS 16. If you're looking for the technical advice, when I joined BDO 3 years ago, we only had 3 IFRS partners, Wayne, Basford in Perth, Clark in Brisbane, and I was the 3rd one in Melbourne. And now we're very excited that we've got 5. We've got Susan Altmeadow Hall joining Wayne in Perth. And then Kevin taking over Sydney, and I can now focus on Melbourne. So fantastic to have a team of 5 partners, and we work together very closely, meet regularly to discuss issues, but also how we can assist clients. Our larger team, based all across the country. I should point out that Lynn is a senior manager based in Adelaide, so we also have representation specifically in Adelaide. And Dean Arden in the top right-hand corner did last month's webinar on IFRS 15 disclosures. He's based in Melbourne with me, and Anita, the right-hand side, she is predominantly looking at a BDO lease management services, our outsourcing a tool. That's her main focus, and also based in Melbourne. So nice, beautiful team of 18 people, 5 partners, and 13 more staff members. So we're very excited about that. And then, finally, thank you very much for joining us for this webinar. I hope you find it useful, beneficial. Please have a look at all our resources that's available. And finally, Kevin, thank you very much for a great job, and speak soon. Speak to you next month. Thank you very much.